Hello and welcome to this market update for January 2022. I am Michael Ball, Managing Director of Weatherstone Capital Management. As a brief overview of the things that we will cover today, we will touch base on the current state of COVID, how it's progressing with the latest variant. We'll take a look at a couple of headwinds and tailwinds potentially for stocks in the coming year. We're going to look also at how different types of bonds performed in 2021, which was a bear market year for bonds. We'll look at inflationary challenges in the bond market, and then we'll look at our current equity and fixed income positioning. While it seems that each quarter it's pretty much impossible for us to get away from talking about how COVID has been impacting the economy, the news continues to be improving, even though we've had a higher wave of new infections due to the Omicron variant. But the good news side to it is that hospitalizations and fatalities seem to be quite low, particularly for those who have been vaccinated. So even though this has caused some additional travel lockdowns and things of that nature, the fact that the disease itself seems to be becoming progressively less lethal is a good sign that we continue to move towards getting the worst of the COVID pandemic behind us. As an example of this, if we look at the number of job openings in the economy, it still remains near record highs. And even with the newest variant out there, very little overall disruption in the job market, which is very good. We've continued to see the unemployment rate move lower and lower. We're now back to below 4%. So this continues to show that we should have some pretty good job momentum and economic momentum building up out there in the future. The strong economic momentum that we've seen has led to another solid year for stock market returns. And also, almost more interestingly, is the very low level of volatility that we saw during the year. In the chart that we have here, the red dots on the bottom half basically show the maximum decline that we had during the course of the year. And so for 2021, it turns out that it was the fourth lowest level of volatility that we've seen going back to 1980. So that made for a nice and quite smooth year. As we move into 2022, I don't necessarily expect that we should continue to see that, because as we see the current bond buying program by the Federal Reserve wind down and some interest rate increases, that's likely to start to cause more uncertainty in the markets in terms of, will they overdo it, and does this potentially overshoot a soft landing, and we may have some economic weakness out there. We've had quite a spike in the rate of inflation over the past year, and we frequently get the question about what does a spike in inflation tend to mean for the stock market. A recent study done by the folks over at the Luthold Group summarized past inflation spikes since 1950. We've had 13 prior cases, and their study looked at how stocks performed in the 1 year after the inflation rate peaked. The numbers in red indicate the years in which the stock market was lower, and the numbers in green indicate the years in which stocks were higher. Most of the time, stocks were able to manage a gain. We'll look a little closer at that in our next chart. When we dig into the numbers a little bit more, we see that stocks averaged a solid 13.2% gain, which is actually somewhat better than the long-term average for the stock market, and that may seem somewhat surprising for many people. However, an important part to keep in mind is that this is looking at how stocks have done at the peak of inflation and then when it started to come down. If we were to look at the prior 12 months to that peak, and we look at the maximum drawdown that was seen, that averaged basically a 12.5% decline, and that's larger than average. And in 8 of the 13 cases, or a little over 60% of the time, those declines were 10% or more. So what we've also tended to see is above average volatility in the time period leading up to the peak in inflation. The current decline that we've seen in the past 12 months is basically right about 5%. That would put it in as the second lowest level of volatility that we've had prior to its peak. So that may either mean that we have more volatility to come, or we're just fortunately going through a very low volatility period. When we look at some other indications about potential strength or weakness in the stock market, there's a couple that are pretty interesting that I would like to point out. One of those that I think is more significant is when we look at the impact of a slowdown in margin debt. With the stock market doing well last year, there was a lot of additional money that went into stocks, some of which was borrowed. And so this chart here in the bottom clip shows the year-over-year change in the amount of new margin debt. The problem comes when growth in margin debt averages above 48% over the rolling 12-month period and then goes and drops below that level. If you look at the box on the upper left-hand side, that indicates when you've had a sell. And historically, in the handful of cases that we've had going back to 1970, stocks have typically struggled. Both 6 months, 12 months, and 18 months later, the stock market has tended to be slightly lower. And so this is coming from a shift where as the perceived risk is picking up, and maybe it's the volatility is picking up somewhat, people just aren't as comfortable using borrowed money, and so that tends to pull back, and that's one less driver for the stock market moving higher. An additional measure that's showing increasing weakness in the underlying stock market comes from when we look at the volume in stocks that are advancing versus the volume in stocks that are declining. And so the bottom clip of this chart basically shows this relationship, and then the box at the bottom tends to show what the historical returns are. And so when there's more advancing volume than declining volume over a longer time period, stocks have tended to go up in double-digit levels, which is good. When we start to see more declining volume than advancing volume, then stocks have really struggled to make headway and have barely generated a positive return. We're seeing that we're getting very close to that level right now, which is really quite surprising given that the stock market has been close to record highs. Typically when we see deterioration such as this, it's typically after more extended declines. But it means that typically the medium, smaller stocks are struggling more, and some of the largest stocks are the main thing that's now driving the market. That's an indicator we'll keep a close watch on going forward. If we do see a significant shift in some of the themes around what's doing well and not doing well in the stock market, one area that we could see emerge is that value stocks, which have been suffering in performance relative to growth stocks, may turn around and reassert somewhat this year. As we can see on the chart on the left-hand side, when we look at the average relationships between which is more expensive, growth stocks versus value stocks, that we now have growth stocks at the cheapest level at which they've been, basically going back to about 1999 or early 2000, where there was also a very wide gap. And then you had nearly a 7-8 year period where value stocks tended to outperform growth stocks. hard to tell what necessarily will be the driver to change that, but if we do start to see that momentum start to change, there could be some good opportunities for some significant outperformance in some of these unloved areas of the market from the past few years. Turning to the bond market, it was a bear market year for most categories of bonds. The most widely followed benchmark, the Barclays aggregate, declined by just over 1.5% for the year. Most government-backed and the highest quality segments of the bond market also posted negative returns, as shown on the table above. While the economically sensitive areas such as high yield corporate bond funds or things that could float, like rising rate bond funds, floating rate bond funds, and treasury inflation protected securities managed to post positive returns. For the Weatherstone investment strategies, the shift in our bond portfolios after the COVID sell-off in 2020 to favor economically sensitive areas of the bond market has continued to work well for us in 2021, when we were typically able to do substantially better than the benchmark areas, and we expect that to continue to be a strong theme as we move into 2022. The bear market for bonds wasn't just in the US. Most of the bond markets around the world also posted negative returns, particularly when you factored in the strength that you had in the dollar last year. So most returns in bond markets outside the US for a US investor were significantly worse than had you stayed and focused on just US backed bonds. There were very few places overall to make money in bonds in 2021. As we look at the primary headwinds for bonds, the biggest challenges of the current level of real yields, meaning what are the yields after we adjust for the current inflation rate, are at some of the most negative levels that we've seen since the end of World War II. If we see inflation continue to remain high and we see investors start to adjust expectations that this is not just a temporary problem and begin to essentially stay away from bonds until yields start to move back to more historically normal spread levels, that's going to continue to put pressure on bonds. And so utilizing floating rate bond funds and things of that nature are going to be much more necessary to basically navigate well through a rising interest rate environment in 2022 if that does occur. Even without adjusting for what current inflation rates look like, yields, if we look at this chart here, are near some of the lowest levels that we have seen here over the past 15 years. This chart basically shows the range in different types of fixed income securities over the past 15 years. Basically, the purple line is showing where the median yield has been over that time frame, and then the little diamonds are where we stand currently. So with virtually every area, we tend to be really on that lower end, and so there's quite a bit of room for yields to adjust higher if inflation or other things cause bonds to move back to historically more normal spreads. While that may be painful if people are in fixed income securities and not floating rate or some of the other areas that can better adapt to that type of an environment, it should give us some good buying opportunities further on down this economic cycle to lock in some pretty attractive yields. When we look at how this current environment is impacting our positioning in our fixed income portfolios, we continue to favor the economically sensitive bond categories over things such as government bonds, and that has continued to support us pretty well on a relative basis as we have moved into 2022. We continue to believe that bonds backed by housing remain quite attractive as that area is continuing to see improvements in terms of the overall valuation of housing, and those bonds are just tending to become stronger as default rates and things continue to drop there. We favor bank loans over high yield corporate bonds because most bank loans have adjustable rate coupons to them, so they can benefit when the Federal Reserve does start to hike interest rates. And as mentioned earlier, if we do see a sell-off continue in higher quality bonds, that could push them to levels that could be overall quite attractive in future years and be able to give us some nice returns there, and we'll look to switch from floating rate bonds back to fixed interest bonds. As we look at our current positioning in stocks, our short-term risk measurement model has fluctuated between positive and negative readings during December. As a result, we did reduce some of our equity holdings a little bit. The model has turned somewhat more positive as we have moved into 2022. We've been slow to increase the equity holdings so far because of some of the deterioration and things that we're seeing on an underlying basis, but we will look to restore that if that starts to strengthen here over the near term. Our short-term risk measurement model for international stocks has also moved to being more positive, but we've tended to continue to see persistent weakness in international stocks relative to US stocks. So we have continued to have our focus primarily be with US stocks. While the short-term risk measurement models are positive, we do have the continued headwinds that come from high valuation, and particularly in an environment where we're going to start to see interest rates going up and things of that nature from the high inflation. That does bring some additional risks and volatility to the stock market. When we look at favored sectors of the market, we prefer US stocks over foreign stocks. We continue to find things in energy, financials, and technology as being some of the more attractive sectors of the overall market. All right, that brings us to the end of this brief summary as we start to kick off 2022. As we've noted, COVID lingers out there, but it's not continuing to be as fatal as it had been earlier in the crisis, which is obviously a very good thing. The inflation playing out with the current spike is something quite unique and something that we haven't seen in quite a number of years. So we'll be closely watching the waves that may start to have inside of the financial markets, particularly if it continues at these quite high levels. And as far as things go in the bond market, we do have a bear market in bonds going on, but our ability to be flexible in terms of how we're allocating has allowed us to navigate that really quite well. And we continue to look for where we'll find some good opportunities as we see some volatility out there that can benefit the portfolio in the coming years. With that, we thank you very much for taking this time to listen to our update, and we'll look forward to visiting with you again in 3 months. Have a nice day.